In the coming months, the United States will face an unprecedented deadline. A staggering $6.5 trillion of public debt is about to mature, a colossal figure that could knock any other economy worldwide to its knees, but not the US. The question is, why? Is this a signal for a historic default that will collapse the global financial system? Or is this simply a pre-planned strategic move, a quiet but calculated move by the financial elites of the United States, who have never allowed themselves to lose, no matter how chaotic the world may be? Imagine that while other nations struggle with soaring debt costs, the US quietly amasses gold, holds massive liquidity, and controls the global market through the very instability it created. This cycle has repeated multiple times throughout history. In 2008, when the bubble burst, the US printed money and bought the markets at a discount. In 2020, during the pandemic, the US was the first to recover. And now, in 2025, is this scenario repeating itself? You will soon see what is truly unfolding behind what seems like dry numbers. This isn't just a story about debt, interest rates, or budgets. It's a story about power, plans, and control, about how a nation can restructure the world to play by its own rules while making everyone else believe it's just an accident. Don't take your eyes off the ball. If you still think that financial crises are random, you are about to witness one of the greatest rehearsals by the global financial elites. And as always, the US is the one writing the script. Welcome to the episode. The United States faces a $6.5 trillion deadline bankruptcy, or a classic restructuring. A big game is about to begin, and you will understand why the winner has already been predetermined. A storm of $6.5 trillion, and the US is about to be submerged under a mountain of debt. This $6.5 trillion is not a symbolic number. It's real debt that is due for payment in the near future, and the United States must face it. No more forecasts, no more economic models on paper. This is the financial reality that is unfolding daily on the federal government's balance sheet. Most of this debt stems from the COVID-19 pandemic period, a time when the United States had to inject money into the market at an unprecedented pace, kept interest rates close to zero, and accepted massive loans to sustain an economy that was partially collapsing. But every time survival is bought with borrowed money, the bill must come due, and that time is approaching. What's noteworthy is that the US faces this debt maturity in a completely different environment, with interest rates no longer near zero, but having surged above 4.5%, with a possibility of further adjustments depending on inflationary pressures and global economic conditions. Borrowing costs have skyrocketed, and this means that just the interest on this debt will create an enormous burden on the federal budget. By mid-2025, the US national debt will exceed $36 trillion, an amount equivalent to nearly 130% of nominal GDP. Refinancing this maturing debt will not be as simple as issuing new bonds. It raises questions about trust and whether the market will continue to absorb US bond issuances in a volatile economic environment. The capital markets are struggling, and central banks worldwide are diversifying their attention. The willingness to fund the US budget deficit is no longer as certain as in previous years. The bigger issue is that the US government cannot immediately slash spending to reduce the deficit. This is because such cuts could directly harm social welfare systems, defense, education, and infrastructure, the areas that form the political and social backbone of the federal government. Balancing minimum spending to avoid social backlash while struggling to meet rising interest payments creates an unprecedented dilemma. If the US cuts spending, growth slows, market confidence is affected, and the debt becomes harder to manage. But if they continue pumping money into the economy, inflation could return, forcing even tighter measures, making debt even more expensive. Over the last 15 years, the US has gone through two major crises: the 2008 real estate bubble and the 2020 global pandemic. In both cases, the solution was aggressive monetary easing, printing money, saving the markets, and accepting higher public debt. But this time, fiscal space is limited, and political space is shrinking as Congress becomes more divided over approving new support packages. The debt ceiling used to be a technical tool for negotiation, but now it has truly become the boundary for national financial survival. People are starting to ask how much longer the US can maintain its current financial model and whether the world will continue to trust the US dollar and US Treasury bonds as absolutely safe assets. These questions are not only being raised in academic circles, but are beginning to appear in closed-door meetings of Treasury departments, central banks, and global credit rating agencies. But the most important question is how the United States will respond to these seemingly unfavorable circumstances. A nation with a history of never defaulting, with a financial system capable of globally influencing markets, will it allow itself to be buried under a mountain of debt? Or is it preparing a move to restructure the system in a way no one expects? The answer won't be on the surface. It lies in deeper calculations, where power is not measured by numbers, but by the ability to control the game. And that's when we need to dig deeper to understand what the United States is truly doing in this financial undercurrent. Because behind these seemingly suffocating numbers, there could be a strategy that has been scripted long ago. Could the US go bankrupt? Or is this a hidden restructuring? Looking at the $6.5 trillion in maturing debt, alongside a total public debt exceeding $36 trillion, many have hastily speculated about a potential national bankruptcy scenario. However, the reality is that the United States is far from being just a debtor. It holds the cards as the issuer of the world's reserve currency, and most importantly, it remains the country in which the global financial market places its trust by default. The question of whether the United States will default is technically accurate, but it is fundamentally the wrong question. What truly needs to be examined is how the United States will manage this situation in a way that avoids default while ensuring that the entire system automatically adjusts in their favor. History has shown that during what appeared to be the most critical moments, the US did not choose bankruptcy. Instead, it chose to reshape the rules of the game. In 2008, when the housing market collapsed, the US did not allow the failure to spread. They launched a massive bailout package, pumped money into financial institutions that were falling, used its own USD to buy back devalued assets, and emerged first from the crisis when others were still struggling to find a way out. By 2020, as the global pandemic threatened to paralyze economies worldwide, the United States continued to intensify its expansionary monetary policy, printing unprecedented amounts of money and accepting additional debt to maintain its role as the global liquidity guarantor. While the US may create crises, it is always the first to recover. This time was no different. The record-breaking debt maturities could have forced many other countries into liquidity crises or debt defaults. However, with the dominance of the US dollar and the world's largest bond market, the US had enough flexibility to maneuver. Rather than drastically cutting or defaulting, the US maintained high interest rates, creating a fictitious tension that caused localized panic in the markets while quietly accumulating cheap assets. As investors fled, liquidity decreased, and asset prices dropped due to the wave of panic. The US, with its abundant reserves, became the ultimate buyer. Essentially, this is not bankruptcy, but rather a form of restructuring not conducted on paper, but through global asset revaluation. Old debts will be replaced with new debt with longer maturities and higher interest rates, but with advantages that the US will create for itself. The increase in borrowing costs, when skillfully combined with reduced global purchasing power and a weaker US dollar, will make the actual pressure of debt relatively lighter. Meanwhile, while the rest of the world struggles to defend itself, the US moves to acquire global shares, real estate, technology, and resources at much lower prices. It is important to understand that this is not a plot drawn in the shadows. This is a strategic response built on the financial power and global monetary credibility of a superpower. The US does not need to announce a restructuring process. They only need to let the market react and intervene at the right time and with the right amount. The end result is to reduce debt while enhancing control over global assets. Of course, no scenario unfolds perfectly. Reactions from other major economies, central banks, or the energy and raw material markets could introduce variables. But it is precisely in such an uncertain environment that the US has the opportunity to adjust the game in unpredictable ways, thus controlling not just public debt, but also the entire flow of capital and global asset values. From an analytical perspective, the United States is not trying to avoid a crisis, but is using the crisis as a policy tool by accepting market tensions up to a certain limit. They are not merely reducing the pressure from dry numbers on spreadsheets, but also creating leverage to regain control over global financial centers. This is a matter for reflection, because if this scenario is indeed taking shape, the next step to analyze is how the world, with its array of counterbalancing powers, will react. Will other nations continue to accept the US's central role, or will new forces emerge, introducing strategies to weaken or break that control? The signs of a shift are becoming increasingly apparent, but no one is sure where the big picture will head. USD, gold, and the chessboard of power. The United States holds the pieces on the board. Amid record debt maturities and sharp global market fluctuations, two key factors always weigh on the balance: the US dollar, USD, and national gold reserves. These are not just financial instruments, but strategic pieces capable of reshaping the global economic order. To understand how the US will react to its massive debt, one must first look at the position it holds with these two assets. The USD remains the dominant global reserve currency, accounting for around 60% of global foreign exchange reserves. This gives the US a unique advantage that no other country possesses: the ability to borrow in its own currency and, more importantly, influence the value of assets worldwide simply through currency exchange rate fluctuations. In the case of an uncontrolled rise in public debt, one simple yet impactful measure is to devalue the USD. A 10% adjustment would be enough to ease hundreds of billions of USD in actual debt when converted into other assets or remaining strong currencies. However, devaluing the USD is not a one-sided game. This is a dual strategy that could benefit US exports while risking a loss of confidence from international investors, particularly those nations holding large amounts of US government bonds, such as China, Japan, and European countries. They all have reasons to react if their USD holdings are actively eroded and if a chain reaction occurs, such as a slowdown in US bond purchases. The US capital market will bear the brunt. This is where gold enters the equation. The US currently holds the largest gold reserves in the world, over 8,000 tons, accounting for nearly a quarter of global reserves. Gold has long been considered a safe asset during times of instability, especially sensitive to fluctuations in the value of the USD. In periods when the greenback is being devalued, gold prices tend to rise, not only due to market mechanisms, but also because of investor sentiment. With its enormous gold reserves, the US can indirectly safeguard the national asset value if needed. But like the USD, gold is not entirely within the US's absolute control. The global gold market is influenced by other central banks, including those in Europe, China, and Russia, which have been quietly but steadily increasing their gold reserves. Every time a major country announces an increase in its gold reserves, global gold prices fluctuate. Meanwhile, geopolitical crises, trade wars, or supply chain tensions can also cause unexpected gold price movements. Despite being the largest gold holder, the US must share the price-dominating power with the rest of the world. The current situation shows that the US has the pieces, but to gain an advantage on the global chessboard, they cannot only look at themselves. USD and gold are two sides of a comprehensive financial strategy where market trust and Fed policies play key roles. Coordination with allies and the attitude of competitors are also variables. A weaker USD could ease debt pressures in the short term, but comes with the risk of undermining its global role. Gold can protect value, but could also become an asset susceptible to manipulation by counterbalancing nations. This makes every move by the US more complicated. In previous crises, the US has used a combination of a strong USD and flexible monetary policies to acquire undervalued assets, reshaping global ownership structures. However, this time, the chessboard has changed. Many countries are actively moving away from the USD, seeking local currency payments or regional alliances. These steps, although not yet enough to shake the US's role, signal that the system is no longer as absolute as it once was. In this situation, will the US initiate a process to reprice global assets or be forced into a multi-party game? The signals indicate that change is imminent, but what is crucial is not the shift of currency or gold prices, but the response of nations who no longer want to be controlled by the invisible hand of a dominant currency. This is sparking new calculations in major powers who will not easily give up their control. The old order is crumbling as China, the EU, and the global community no longer want to play by US rules. For decades, the USD and the US-led global financial system were the default rules that most nations, whether reluctantly or willingly, had to follow. But recent turmoil, including financial sanctions, tariffs, and the US's unilateral withdrawal from certain international trade commitments, has led many major powers to question the sustainability of this system. Increasingly, there are signs that the old order is wavering, and not everyone is willing to let the US remain in charge. China is the clearest and most decisive example, pushing aggressively to internationalize the yuan. Beijing is not only building a financial ecosystem parallel to the US's, but is also gradually drawing major trade partners into its system. From the Belt and Road Initiative to the cross-border payment system, CIPS, China is creating alternatives to SWIFT and the USD, not by direct confrontation, but by offering new options. This shift is not just technical, but reflects growing dissatisfaction with the over-concentration of financial power in the US. For many countries, especially those that have been sanctioned or restricted from accessing US financial markets, the USD is no longer a symbol of stability, but a tool of political control. Being excluded from SWIFT, having assets frozen, or losing access to liquidity in USD is no longer a distant risk, but something that has already happened to Iran, Russia, Venezuela, and potentially any country opposing Washington. Europe, despite being a traditional ally, has also started taking more cautious steps. The European Union has discussed mechanisms for independent payments from the US, even experimenting with an instack system to maintain trade with Iran without using the USD. Although limited in scale, these tests reflect Europe's strategic aspirations to avoid dependence on a single currency, especially when decisions about it do not always align with the bloc's interests. Beyond major powers, many developing countries are also gradually seeking a way out of the US's financial orbit. The increase in gold reserves, the use of regional currencies for trade payments, and growing bilateral transactions in local currencies among BRICS countries are evidence of a process toward autonomy. On a global level, this is not a direct assault on the USD, but a controlled withdrawal from the old system. Of course, abandoning the USD's central role is a long and complicated process. No one can immediately replace a system that has existed for decades with such depth, breadth, and liquidity as the US financial system. But the important thing is that the dependency mindset is changing, and this is enough to create significant disruptions if capital flows begin to shift. For the US, this is the real challenge, not because they lose power immediately, but because each step away taken by other countries weakens the ability to use the USD as a strategic tool. When countries stop using USD for payments, the demand for US government bonds also decreases. As gold reserves increase, rather than USD reserves, the pressure on the real value of the USD intensifies. And if this trend continues, the US will gradually lose its ability to print unlimited money without facing immediate consequences. The noteworthy aspect is that these moves are not happening in silence. At international forums, from the G7 to BRICS, discussions about alternative payment systems, non-USD trading currencies, or a rebalancing of the international financial structure have become a major topic. Although there are still many differences between countries, the common point is that no one wants to be entirely dominated by a single axis anymore. In this context, the position of the United States is no longer a given. It has become an option that is now being reconsidered. When power shifts from being the default to a competitive one, every strategy involving the USD or gold must confront responses from the rest of the world. The question now is not just what the US will do next, but also, while the US prepares new moves, are competitors with ever-increasing power setting traps on the very chessboard the US once controlled. These movements are occurring faster than imagined, and behind the outward calm, clashes are building layer by layer beneath the surface of the global financial system. As the elites buy the world on the cheap, who will be the losers? When global financial markets are shaken, when asset prices plummet and panic spreads from Wall Street to exchanges in Tokyo, Frankfurt, or Hong Kong, a force will quietly begin to act. Not governments, not central banks, but the financial elites, corporations, investment funds, and interest groups who are all too familiar with using crises as opportunities. If there's a strategy that has proven effective through multiple crisis cycles in the past, it's buying the world on the cheap while everyone else is running for cover. Modern history offers many clear examples. In 2008, when the US financial system collapsed due to the housing bubble, millions of people lost their homes and thousands of businesses went bankrupt. But alongside this collapse was an unprecedented wave of asset acquisitions. Investment funds like Blackstone, Vanguard, and major banks such as JP Morgan Chase took advantage of bailout packages to snap up fire-sold assets at bargain prices. When the market recovered, others still struggled, but those institutions had multiplied their assets many times over. The 2020 pandemic was no different. As global stock markets plummeted in the first quarter, the US Federal Reserve unleashed unprecedented stimulus packages, keeping liquidity at record highs. While people lost their jobs and small businesses shut down, large capital flows surged into the markets, buying up stocks, real estate, technology, and even farmland. Everything could be revalued as long as there was liquidity to wait for the moment when others could no longer hold on. The elite understand a core principle in times of crisis. Real value doesn't disappear. It only temporarily deviates from its equilibrium point, and it is the panic of the masses that creates an opportunity for them to redistribute global asset ownership legally. What is called a market correction is actually a cover for a large-scale asset transfer from weak hands to strong hands. And with the right timing and enough liquidity, a small group can reshape the entire economic power map. The US government plays an intermediary role in this process, not by direct intervention, but by maintaining a predictable financial environment for large institutions. Bailout packages, low interest rates, and large-scale monetary easing all indirectly facilitate financial elites' actions. While some of the population will receive subsidies, others, the elites, will use this environment to expand their ownership influence. This is not illegal behavior, but it raises questions about fairness and risk distribution in each crisis. The concerning part is that this model may be repeating itself once again with massive debt maturities and the likelihood that asset markets will have to adjust sharply to reflect higher capital costs and a growing global cautious sentiment. A massive sell-off is entirely possible. In that case, those institutions with access to cheap capital backed by central banks and with a global network will once again play the role of the last buyer. Meanwhile, individuals, small businesses, and vulnerable economies will be forced to sell what they have not because they want to, but because they can no longer hold on. The question now is, who truly benefits when a crisis occurs? And is there any alternative for the rest of the world, the ones paying the price with lost assets, lost opportunities, and lost control? In a system where currency and policies are not in the hands of the majority, the gap between the beneficiaries and the sufferers is becoming increasingly difficult to close. This situation is not just an economic issue. It is a structural issue, a question of power, because ownership of assets also equals control over the future. When a small group can control financial cycles by using information, policies, and access to capital that others do not have, imbalance becomes inevitable. And this is the critical point that needs careful observation moving forward. Because if the asset accumulation cycle begins again and the elites continue to buy the world cheaply, what will be in store for the rest? Those who do not have the chance to be on the right side of this game, the answer will not lie in stock market charts or bond issuance rates. It will come from how the system responds when the balance of power tilts too far to one side, and whether this shift can happen quietly, crisis or strategy, when all fluctuations might have already been scripted. Crises are often defined as unexpected events that disrupt markets or economies, causing them to lose control over a short period. But when major crises, from the 2008 housing crisis, the 2020 pandemic, to the debt crisis of 2025, follow a familiar cycle and end with assets concentrating further in the hands of a select few, the question that must be asked is, are these truly natural disruptions, or is this a scenario that has been pre-prepared? On the surface, everything seems to unfold as part of a normal response chain. Debt increases, interest rates adjust, the market corrects, and then the crisis emerges. But when large financial institutions maintain liquidity, when major investment funds have never drowned along with the market, and when the US, the center of the global reserve currency, is always the fastest to recover, it might be time to reconsider whether the crisis is simply an incident. Perhaps it is a tool, a mechanism to reset the market order, to reprice assets, and to refresh ownership cycles. But with the advantage going to those holding the policy reins, the US, in the current financial structure, has enough tools to never become a victim in a crisis. They have the currency that the entire world uses. They have a central bank capable of creating unlimited liquidity. They have a bond market regarded as the final safe haven for global investors. And they have the political power to shape international reactions when markets fluctuate. When needed, they print money. When needed, they cut interest rates. When needed, they intervene in asset markets. And each time they do so, the global financial system is reset. But not randomly financial elites, both domestic and abroad, understand this well. They do not wait for fluctuations to react. They prepare scenarios to take advantage of them. Because in a crisis, the disorientation of the masses is the opportunity to act without opposition. When the market panics, all reason is suspended, all principles are put aside, and any measure, even extreme ones, can be justified with the familiar phrase, necessary to save the system. It is in this context that the term global restructuring arises not from parliamentary chambers, but from the internal reports of financial institutions, closed-door meetings between central banks and interest groups, and long-term plans that are not publicly disclosed. Every major fluctuation in the financial system leaves a trace. And if you follow long enough, you will see repeating signs. A crisis cycle, a bailout package, a money printing spree, an asset buying cycle, and then it repeats. This does not mean that everything is staged. No one can fully control global factors, from war, pandemics, natural disasters, to social upheaval. But when a crisis occurs, how someone responds to it will show how prepared they were. And it is this ability to respond with control that creates the sense that everything has been calculated in advance. In reality, other nations are also learning how to prepare. China is increasing its gold reserves. Russia is moving away from the USD. India, Brazil, and many others are searching for new payment systems. Europe is starting to discuss financial strategic autonomy, and non-traditional economic alliances are growing. But all of these efforts are still revolving around a central axis. They are reacting to uncertainty that they no longer believe is random. The final question is not whether a crisis is real, but who has prepared for it and who has not had the chance to prepare. In the modern financial world, failing to prepare is being predetermined. And if what we see is just the tip of the iceberg, then where are the hidden deals, calculations, and powers? And more importantly, what will we, as those affected by the consequences, do when we realize that it may all have been written long ago? Perhaps you have already started asking the question, is what's happening around us random or part of a calculated series of moves that most of us will never know? Could this be a crisis, or is it a strategy hidden beneath the cloak of chaos in a game where the pieces have been arranged in advance? Who truly holds the power to make decisions, and who merely follows the consequences? Leave a comment below. Do you think the US is facing a real crisis, or is it executing a purposeful global restructuring? Your perspective will be an important part of the growing global discussion. And don't forget, sometimes understanding what happens behind the scenes is the first step in not becoming a guided spectator. If you found today's podcast episode interesting, don't forget to leave a like, share it, and subscribe to my YouTube channel. There are many more interesting things that can help you